Hello, this is Drummond with a fourth quarter review of the CI Global Income and Growth Fund. The fourth quarter of 2021 saw a rapid economic rebound out of the Delta-induced slowdown that occurred over the course of the summer. As a result of the economic rebound, we also saw interest rates continuing to sort of firm up and rise, and inflation continue to be well above expectations as we entered 2022. As a result, we saw in the fourth quarter, the Fed pivoted, the U.S. Federal Reserve, to a more hawkish stance and began the process of reducing the tapering of its quantitative easing program. Towards the end of the quarter, we also saw the Omicron variant show up. And while we expect the Omicron to have a pretty significant impact in the very short term, we do expect it will be short-lived, as was the case with the Delta variant. Most developed market equity markets also rallied strongly during the quarter, with most setting new all-time highs towards the end of the year. Over the quarter, the CI Global Income and Growth Fund had a strong quarter, increasing by 6% versus a 3.6% rise in its benchmark. The outperformance on the fund was driven by two key factors. First was the strong equity selection across most sectors of the fund. And secondly was our asset allocation, where our overweight to equities and our underweight to government bonds worked well. Entering into 2022, we expect a continuation of the strong economic growth in developed markets, albeit they will be at a slower pace than we saw in 2021. Inflation will also remain a key factor, and while we do expect the current very elevated levels of inflation to moderate as supply chain chaos normalizes, inflation is likely to remain above central banks' target levels, particularly the Fed in the U.S., and it's for that reason that the Fed in the U.S. has clearly pivoted to a far more aggressive timeline for the raising of interest rates in 2022, which is now expected to begin in the late first quarter, early second quarter of the year. We still expect that equities will be outperform bonds for 2022, but that it's going to be much more of a grinding and bumpy year for investors. And it's for this reason that we have lowered our equity weights back to a neutral stance as we start the year, with the expectations of opportunities to increase it as we go forward. Thank you.